For the equity market savvy investors, IPOs offer good opportunities to make money. Now, with a simpler IPO already on, we look at the opportunities that are presented by this and how we can use that to make money.
An initial public offering, or IPO, is the very first sale of stock issued by a company to the public. Prior to an IPO, the company is considered private with a relatively small number of shareholders made up primarily of early investors. These may include the founders, their families and friends, and professional investors such as venture capitalists. A good example of an IPO in Uganda is that of drug maker Cipla that listed on the Uganda Securities Exchange last month. The main motivation for listing on the stock exchange is capital mobilization by the company. Private companies have many options to raise capital, such as borrowing, finding additional private investors, or by being acquired by another company. But by far, the IPO option raises the largest sums of money for the company and its early investors. For Cipla's case, for instance, it is seeking to mobilize $45 million through selling an 18% stake in the company at 256.5 shillings per share. Some of the biggest IPOs in the world include Alibaba Group in 2014 raised $25 billion, American Insurance Group in 2006 raised $20.5 billion, Visa in 2008 raised $19.7 billion, General Motors in 2010 raised $18.15 billion, and Facebook in 2012 raised $16 million. Other than capital mobilization, other dividends abound, the notable one being the strengthening of the company's credibility. This is because before companies list, they go through a rigorous process where they have to meet certain criteria related to sound business practice. Until a company's stock is offered for sale to the public is unable to invest in it. The public consists of everybody else, any individual or institutional investor who wasn't involved in the early days of the company and who is interested in buying shares of the company.